2 words, Revo Fitness. Here's a few more. Simple, 24/7, reformer Pilates, body scanners, massage chairs, squat racks, free weights, pin and plate loaded equipment, no lock-in contracts, no bullshit. All of that and more from just $9.69 a week. That's surprisingly affordable. Join now at Revo Fitness Blair Athol or download the Revo Fitness app. RevoFitness.com.au or find the Revo Fitness app in the App Store.
Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. With the ASX recently entering correction territory, albeit briefly, there were plenty of calls to buy the dip. After all, it was Warren Buffett who said to be fearful when others are greedy and greedy when others are fearful. But it might not be as simple as that, particularly when plenty of companies are still potentially overvalued. I wanted to look today at buying in a market pullback, deciding fair value, and whether it's time to make a move. Of course, this information is general in nature and doesn't take into account your own circumstances. You should always do your own research and seek professional advice before making investment decisions. Lochlan Halloway is the equity market strategist at Morningstar. Lochlan, welcome back to Fear and Greed.
Good to be back.
Buying the dip's not quite as easy as it sounds, is it?
Yeah, that's right. I mean, when we think about just looking at what the price has done, I think we need to go a bit further. So if you're just going to buy something because price has fallen X% in a trading session, you kind of have to make two assumptions if you care about valuations. Firstly, that the fundamental picture didn't change and that dip was not reflecting something genuine about the business and its outlook. And secondly, if you're looking for value, you have to assume that the new price at which it is trading offers some value, that it is now undervalued and now, in that sense, worth buying. If something's 30% overvalued and it corrects 10%, you're still buying something expensive, less expensive, but expensive all the same. So I think when you talk about buying the dip, I think we have to keep those 2 points in mind.
Okay, so how do you work out then whether it's expensive or not?
Yeah, that's a good question, and it comes to the core of the way we look at markets, our valuation methodology. So we look at individual companies globally, but in this office in Australia and New Zealand, and we look at them on a discounted cash flow basis. So how much cash effectively do you think this business will generate from now into perpetuity? It's a fairly standard approach to valuations. We consider things like the company's industry, the company itself, its idiosyncratic competitive advantages or its economic moats, and we project those out. Obviously, different approaches for different companies, but that's broadly speaking the way we look at it. That gives us a company level valuation or fair value estimate, but we can also roll that up. We cover 200 ASX and NZX listed stocks, and we can build that up to a market level picture to get a sense of, well, okay, overall, where do valuations sit across those two exchanges?
Okay, now might be, Lochlan, asking the impossible. Without too much maths, explain the market cap weight method of valuing a company.
Sure. So again, going back to that view of rolling up these fair value estimates, these company-specific valuations, there's a couple of ways we can do that. And you point out one, which is to weight them by their market capitalization. Now, I understand this is going to give more emphasis on larger companies. If we did a very, very simple example, we'll take two, fairly well-known ASX companies, retailer Wesfarmers, conglomerate Wesfarmers, and oil and gas producer Santos. Wesfarmers, it's about an $80 billion company. Santos, about a $20 billion company. If we just said that was the entire market, Wesfarmers would be 80% of that market and Santos the remaining 20%. Now we can put valuations on those two businesses. And at the moment, we see Wesfarmers at a fairly steep premium to what we think it should be trading at, about 60%. And on the other side of things, we see Santos is undervalued. It's almost a 40% discount to its fair value estimate, in our opinion. Now, if we wanted to find a valuation for that market as a whole, we would take Wesfarmers' fair value estimate, we'd multiply it by its 80% weighting, and we'd take Santos's fair value estimate, the discount, multiply it by its 20%, and we'd roll it up into a headline number for the market as a whole. And at the moment, it would still be, on those two basic companies, it would still be overvalued, about 40% overvalued, because that Wesfarmers premium dominates in a market cap weighted index. So if we look at the market like that, and if I generalize this to our true comprehensive coverage of the ASX, we still see the market as overvalued even after the 10% correction over the last couple of weeks. So it was about 20% overvalued before the correction. It's now about 10% overvalued. So it's pulled back. It's not as expensive as it was, but it is still in general overvalued, and it's primarily because of the influence of those larger companies.
Yeah, so the market cap weight method, is it things like banks and that which have such a huge weighting in the local market that gives the premium to the local market?
That's absolutely right to look at it that way. So obviously, you're putting more emphasis on the big companies when you weight things by their market cap. The ASX 200 benchmark index is a market cap weighted index, so it's going to have a higher allocation to bigger companies. Banks, the four majors make up about 20% of the index by market cap. CBA alone is about 10%. So if you have that particular sector of the market looking expensive, and in general we think it does, you wouldn't be surprised to find that the market overall looks overvalued.
Okay, so another option is to talk about an equal weight methodology. So we've been talking about market weight. Equal weight, presumably in your example, Wesfarmers and Santos get 50% weighting.
That's right. Yeah, in that very simple example, they would. Again, if we use the numbers from earlier that Wesfarmers is quite overvalued and Santos is quite undervalued, if I did the 50-50 weighting to each, then the market would come out as slightly overvalued, because in this example, Wesfarmers is more expensive than Santos is cheap, but it would be a significantly lower premium to fair value under that approach, because we're weighting the two companies equally rather than having the valuation dominated by the very large company of the two, Wesfarmers. Now, what that does is it allows us to take a little bit more of a look, more of a comprehensive look across valuations over the entire market. It's not just skewed by very large companies. So if you are a big institutional investor, you're probably going to be holding things, close enough to market cap weight that maybe looking at it on a market cap basis is the right way to assess value. But if you're an individual investor or you're unconstrained, you can hold, small caps. You can hold the market in an equal weighted proportion. You have a lot more flexibility and diversity there. So looking at it on an equal weighted basis might give you a bit more of a sense of, actually how much opportunity lies across the entire ASX and not just focusing on the large companies.
Okay, I want to talk about how investors can now use these methods to inform their strategies and get a couple of stocks to keep an eye on. We'll be back in a minute.
2 words, Revo Fitness. Here's a few more. Simple, 24/7, Reformer Pilates, body scanners, massage chairs, squat racks, free weights, pin and plate loaded equipment, no lock-in contracts, no bullshit. All of that and more from just $9.69 a week. That's surprisingly affordable. Join now at Revo Fitness Blair Athol or download the Revo Fitness app. RevoFitness.com.au or find the Revo Fitness app in the App Store.
My guest this morning is Lochlan Halloway, equity market strategist at Morningstar. So we left talking about the benefit of equal weight methodology, particularly for individual investors. Would you recommend one over the other at any certain time?
Look, it's going to depend on how the investor likes to look at the market. There's not really a preference. I mean, there are two different ways of looking at the market, of assessing valuations. Not to say that you will always follow one investment strategy or the other, but it gives you two different benchmarks to assess, is the Australian equity market overvalued or undervalued or fairly valued at any given time? Now, obviously, there are certain products that, available for investors that are market cap weighted products, like just simple ASX 200 benchmark tracking ETFs, for example. Yep. There are also equal weighted Australian and, global products and ETFs. So you can invest like that if you want. And if you look through into the underlying constituents at a very, very simple level, if you have large companies that you see as very expensive, like we do in Australia at the moment, then perhaps you'd say, well, let's try and diversify away from those companies, reduce the concentration risk, and have something like more closer to an equal weight allocation across asset classes. Obviously, that's not, this is your general approach, but that might be more attractive when you see large cap companies looking expensive.
Okay, just remind listeners, this is not investment advice. Of course, go and speak to a financial planner if you want investment advice. Let's bring small caps into it, because what you're sort of inferring here is at a time now where small caps are trading at a discount to large caps and have done for quite some time, then one methodology, in this instance, the equal weight, might actually be a better option than the market cap weight.
Yeah, I think that's fair. It will give you a relatively higher exposure to smaller companies if you choose to invest like that. I think you have to be careful when you do invest in small caps. I mean, often there's a reason why they're small. They might be at the start of their journey and they haven't established a moat, or they might be on their way to establishing a moat or a competitive advantage, or they might have been a former large cap that has fallen out of favour for reasons that might be justified or not. So there is a bit more risk there. And I think specifically in the Australian context, our small All Ords index has a fairly poor track record of performance because of the way, the listing rules about companies here and the fact that we have a lot of smaller exploratory miners in that part of the index that don't have a great track record of performance. So I don't think the sort of shotgun spray approach there makes a lot of sense, because you probably should be applying the way we look at it, I should say, is that you should look at things based on their intrinsic valuations, their qualities as a company, and just sort of indiscriminately going into a certain part of the market may not be the best approach.
Okay, so let's talk about a few small caps that I know you've mentioned recently in a note. Domino's Pizza, which might have been a mid-sized cap at one point, it's probably now a small cap. That isn't at the start of its journey, but why do you like it?
Yeah, look, that's probably in the bucket of stocks that I alluded to earlier, which is companies that were, formerly, in Domino's case, a market darling that has fallen, at least in the eyes of the market, on hard times. We think that the sell down is unwarranted. Domino's, it's a moated brand in our opinion. It's globally a successful brand, a strong store concept. It has a strong track record before this recent period of cost inflation and sales slowdown, of store growth outstripping, cost growth, which is what you would look for in a strong brand. Yes, coming out of COVID, they overexpanded. This is Domino's in Australia, that is. The Domino's Pizza, which is a master franchise in Australia, but also has operations over in Europe and Japan. But we think that represents more sort of short-term cyclical issues that we're seeing across the consumer environment more broadly. This is a tough time to be a retailer. Things look like they're getting better, but it is still difficult. And we think Domino's brand is still there and its growth outlook is still intact, and the market takes a different view. So that's why we see Domino's Pizza as undervalued.
Another one, Bapcor, which many people, they may not know the head company, but, Burson's, Autobarn, Midas, that organisation, you quite like that one too?
Yeah, that's right. Again, probably to some degree in a similar bucket. To Domino's, there are concerns there around what the rise of electric vehicles might mean for auto parts retailers. That's fair, but we think, again, these are sort of overblown concerns. It's had a slowdown recently, but we think it has, a cost advantage over many of the smaller competitors in that environment. We think that again protects it and should allow it to earn economic profit in the long run. So again, I put that in a similar bucket to Domino's, in that it looks like an oversold company that has, its fundamentals, broadly speaking, are intact.
And finally, SiteMinder.
Yeah, that's right. So SiteMinder, they're an interesting one, and they're probably a little bit different to the other two that I mentioned, because this is really looks like an up-and-comer as opposed to something that's been unfairly treated. SiteMinder, they're an e-commerce software provider for the hotel industry, particularly sort of at that smaller and mid-sized hoteliers end of the market. The SaaS business model looks like it will really work quite well there, because you don't have to develop something in-house. It's something that they can roll out quickly, with incremental profits on not a lot of additional investment, which is a great business model in general. Their metrics on how much it costs them to acquire a customer versus the lifetime value of that customer based on the subscriptions that they'll receive look really, really strong and much higher than, the sort of benchmark across the software as a service industry. So we think they're at the start of a really positive growth journey, and that's another one of the small cap picks that we see at the moment.
Lochlan, thank you for talking to Fear and Greed.
Great to be here. Thanks.
That was Morningstar Equity Market Strategist Lochlan Halloway. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.
2 words, Revo Fitness. Here's a few more. Simple, 24/7, reformer Pilates, body scanners, massage chairs, squat racks, free weights, pin and plate loaded equipment, no lock-in contracts, no bullshit. All of that and more from just $9.69 a week. That's surprisingly affordable. Join now at Revo Fitness Blair Athol or download the Revo Fitness app. RevoFitness.com.au or find the Revo Fitness app in the App Store.